And now to the big proposal that has been made by the central bank. We were earlier talking about the central bank that it wants to further tighten the norms for banks to really lend to large borrowers in what they hope will mitigate the risk taken over by the lenders. Now, our in-house expert Lata Venkatesh is right here to get us more details on this. Lata, good to have you on the show. What does this really mean?
Well, primarily until now, every bank has limits to which it can give loans to a single corporate borrower. And that is 25% of its net worth or 25% of its capital. It can't expose itself to one group more than 25% of its net worth. But there are no limits on the overall banking sector and how much the banking sector can expose itself to one group. These limits were not known also because the sector-wide exposures were not available with the Reserve Bank. It is only now that the Reserve Bank has set up this CRILC, this centralized information system, where it has information across banks to their exposure to large groups. So now what the Reserve Bank is proposing is that there must be sector-wide limits also. Otherwise, we are in a situation where the banking sector is overexposed to some leveraged groups. All of us know the top 10 or 12 leverage groups, the Adani Group, GVK, GMR, Lanco, ADAG, the Jindal groups. We know the normal highly leveraged groups. Not all of them are not paying on their, paying their interest. They are not NPLs or bad loans. But there is a concentration risk to the banking sector. So the discussion paper that has been, it's only a discussion paper, it's a proposal. The discussion paper released by the Reserve Bank states that it is going to specify which are the large exposures. And according to it, in the year FY 17-18, so clearly it is for the next year that they are proposing, a specified borrower or the borrower for whom it is specifying banking exposure limits is those who will have over 25,000 crores loans from the banking sector. In 18-19, it will be those who have over 15,000 crore. So they will expand the rules. And from 2019 onwards, those who have loans more than 10,000 crores from the banking sector. What will be these rules? It is not as if banks will be told you cannot lend more than 25,000 crores to them. This is sector-wide limits, okay, not one single bank's loans. What the RBI is saying is if you are going to lend over and above this 25,000 crores to that to a specific group, then you have to put 3% provisioning and 75% risk weight. So from your capital, you have to have a higher risk weight. And from the asset provisioning, standard asset provisioning is 0.4. So that is dramatically getting raised to 3% if you give additional loans to these groups which have over 25,000 crores exposure to the entire banking sector. That is the new rule being proposed. So it will increasingly become difficult for the banking sector to take increasing exposure to the already leveraged groups. That is the system that the Reserve Bank is trying to put in place. As yet, one knows that these are the groups which have more than 25,000 crore exposure currently, but we don't know what the situation will be after FY 17, in the year FY 17-18. So that really is the situation. Increasing loans to already leveraged groups will become expensive for banks. They can still give, but they have to provide more and set aside more capital. That's what the Reserve Bank is trying to say.
All right, Lata, and we also have now on the phone line former chairman of State Bank of India, Mr. Pradeep Chaudhary, who's joining us with more take and expert take on this particular development, and Lata will take us through more of that.
Mr. Chaudhary, thank you very much for joining us at short notice. I'm sure you may not have been able to read the details, but this is a discussion paper, the framework being...
I've seen that.
Okay, sir. Your first comments then. Do you think it's a sensible setup?
RBI has made a habit of making the most simple things complicated.
Okay.
You can see that from MCLR, and that trend continues. Now, if RBI feels that, these groups are highly leveraged already and they should not take any more loans, why go through all this, that they increase the risk weight? You put a lid on that. There's no further lending. And then, and no further lending from Indian banks because you think that these debts are at an unsustainable level. Ban them from the external commercial borrowing market also. So apply straight solutions and direct solutions. rather than going through a convoluted solution.
No, but why would you say it's convoluted? Isn't it best
Of
to
course.
give incentives and
Either you say
disincentives?
either
You
you
can
say
expose
that-
yourself, but you have to provide
why should you do
more
that?
provisioning.
Why should you do that? You say no. This is a level at which I am uncomfortable, and regulators all over they say that if banks get more exposed to this group or this particular activity, it can put the entire system at risk. So if that is the thought, let RBI say this far and no more.
But isn't it better to have disincentives? After all,
it is
high
like,
risk.
You should not jump a red light. Now, red light, but provided you pay 5,000 rupee fine, provided you go through this, then you can go in a red light. What is this regulation?
No, I don't think it is a red light, Mr. Chaudhary. It only
be.
says that there could be danger. It is quite possible
there
that
is a
higher
danger,
leverage
so you
groups
put a
are
lid
able
on
to
it.
pay back the money, and
You
therefore,
You
go
take an
ahead.
unequivocal stand. It's a danger or not a danger. If it is a danger, put a halt.
No, I don't think it is danger or not. It is increasing
No, so
danger
then
or
you will
decreasing
have-
danger.
Yes, of course. Then why go going through all this?
Okay, so what is your point? Do you think they should not put these limits? Or
no,
do you
they
think...
should put clear limits. That this is go, this is no go.
Okay. But you think
That-
banking
That's
sector-wide
right.
limits
And
are called
secondly,
for?
This has not built up in a day. Every exposure, every quarter, every half year, RBI has been receiving the data. So they could have acted before, and rather than allowing the situation to come to such a pass.
Okay, but this is a discussion paper and it will come
Right.
into effect only in FY18. So starting April 1, 2017, it strikes.
Okay.
So the system has some
I
time
think
to adjust.
it is better, if everybody knows what to expect.
Okay.
So you say this, so you tell the group why you have drawn enough from the system, now no more.
Okay, so your point is that the rules
It
should
should be a
apply
go,
from
no
April
go
2017?
simple.
Sir?
Simple, so that everybody knows, the bank knows, the customer knows that I can't borrow, I am off the credit.
Okay, but
market.
basically you're okay with the system-wide limits?
This is convoluted, making it complicated.
No.
And then what about bond market?
No, they have
Then
some
these
rules.
people should not.
No, they have some rules on bond
also.
markets which I didn't read out. It says that banks may subscribe to the bonds issued by these borrowers, but they want them to, it should be not less than 30% by, they have to bring it down in subsequent years. That seems to be, okay, it's the other way around. They want them to take exposures increasingly through bond markets. So it is 30% by March 31st, not less than 60% by March 31st, 2020, and 100% by March 31st, 2021. I'm not very sure I've read that correctly to you. Mr. Chaudhary, I'll just read out that rules. Banks may at their discretion subscribe to bonds issued by the specified borrowers, that is the large borrowers, in the first year of this framework taking effect, 2017-18, subject to existing investment guidelines, and these being sold off in the subsequent years with the following milestones. Not less than 30% to be sold off by March 31st, 2019, not less than 60% by March 31st, 2020, and not less than 100% by March 31st, 2021. So I
It
guess...
is all theoretical things. Bonds, particularly distressed bonds, have no market. And what are they saying? That if you take an exposure in a difficult company through a bond, it's okay. If it is through a loan, it is not okay. How
No,
can it be?
No, they're asking you
What
to
can
sell
be
off.
a bigger contradiction than this?
No, sir, I think they're asking you to sell off.
Which one?
Banks,
They know very well.
subject to
that
the
any
existing
bond
guidelines...
which is below AA has no market. So sell-off is a theoretical exercise.
Okay.
Will RBI give a repo on these bonds?
where one hopes by then a junk bond market will grow. This is...
So then let RBI do a repo. They say you bring these bonds to me, I'll do a repo.
Okay. That's a suggestion you can give. I think suggestions
No,
are
I won't.
expected.
I want their only confusion confounded.
Okay. Fine. Mr. Chaudhary, thank you very much for joining us with your take. So that's a very caustic criticism coming from Mr. Pradeep Chaudhary that the RBI should give firm controls and not give incentives and disincentives. But I personally would think that it's better that the Reserve Bank doesn't give firm limits, but says that if you cross the limit, then you have to make higher provisions and set aside higher capital. That's what the Reserve Bank is coming with.
Of course, some controls have come in over here, Lata, but I would also say that banks are already very wary of giving out
Yes.
debt to the already leveraged leveraged companies at this point. So I don't know what is the immediate impact, but yes, some controls going forward. Thanks.